428. The hidden cost of the renewable energy transition is emerging. Projections that industrial applications could consume 85% of global silver supply by 2030 point to a structural crisis that most market participants haven't noticed. The solar photovoltaic sector is at the center of this demand, and the mechanism operating at the core is creating a supply-demand imbalance that will fundamentally change price discovery. I am not a financial advisor. This is not financial advice. The analysis presented is based entirely on publicly available data and industry reports. 2024, the turning point. 2024 saw global solar installations reach 597 gigawatts of capacity. This figure is not just a statistical data point, it's a physical reality where millions of photovoltaic panels were deployed, each containing an average of 20 grams of silver. 20 grams may seem trivial, but when multiplied by hundreds of millions of units, the resulting total constitutes a critical bottleneck in industrial metallurgy. In the spot market, silver is currently trading in the $65 to $67 per ounce band. These levels being significantly above historical period averages reflects the structural change in fundamental demand dynamics. But current pricing represents the beginning of the story, not the end. The non-substitutability of silver. The technical basis for silver use in photovoltaic cells is simple but indisputable. Electrons produced when sunlight strikes the silicon cell must be collected and conducted. Silver paste is applied to the cell surface via screen printing method, forming the finger busbar structure. This structure collects the generated electricity with minimum loss. Why silver? Because it has the highest electrical conductivity of all metals. While copper is at 97% conductivity, silver is at 100%. Thermal efficiency and optical reflection properties directly affect panel performance. Alternative material research has been ongoing for a decade. Copper, aluminum, graphene-based solutions were tested. None captured silver's performance combination. Thrifting techniques are reducing consumption per panel, yes, but not eliminating it. Silver continues to be a fundamental input for efficient photovoltaic production. Here's the critical paradox. While silver use per panel decreases, the exponential growth in the number of panels produced increases total consumption, where the numbers speak. In 2024, the solar sector consumed over 200 million ounces of silver. This equates to more than 6,000 metric tons, a single sector in a single year. COP28 commitments envision tripling renewable capacity by 2030. Solar energy is expected to drive 65 to 80% of this growth. Current global photovoltaic capacity is at 2.2 terawatts level. Under an aggressive scenario, the 2030 target is 8 terawatts. Reaching these targets requires annual 1,000 gigawatt installations, nearly double 2024. Every gigawatt means millions of panels containing silver. The calculation is simple. By 2030, the photovoltaic sector alone will demand over 250 million ounces of silver annually. Supply side. All constraints. Global mine production is stagnant. The expectation for 2025, 813 million ounces. This figure hasn't changed for years. Recycling adds approximately 150 million ounces. Total supply is around 950 million ounces. 2025 demand projection, 1.12 billion ounces. The deficit, 170 million ounces, just for this year. The market has been in structural deficit since 2021. Cumulative deficit through 2024 is 678 million ounces. Another 95 to 118 million ounces will be added in 2025. Total, approximately 800 million ounces of missing supply. Where is this deficit being met from? From above-ground inventories, refinery stocks, exchange reserves, investor holdings, and these stocks are rapidly melting. The fundamental constraint in silver production lies in the structural nature of mining economics. Approximately 70% of global silver supply doesn't come from primary silver mines. It emerges as a byproduct of copper, lead, and zinc extraction. This dependence creates a critical dynamic. Silver production is subject to market conditions of base metals. When copper prices fall, mining companies curtail copper production. The result? Silver output decreases even if silver prices have risen. New mine infrastructure requires years and billions of dollars of capital. Price signals don't trigger instant supply response. Supply elasticity is extremely low. Meanwhile, demand layers are accumulating. Solar isn't the only driver. Electronics, electric vehicle batteries, 5G infrastructure, medical devices, artificial intelligence hardware. Every smartphone, every laptop, every electric vehicle battery management system contains silver. In 2024, industrial demand broke records, and momentum is increasing. But photovoltaic is the major momentum source. Why? Because the green energy transition is no longer voluntary, governments worldwide have set legally binding emission targets. Institutional investors are applying ESG pressure. Solar energy is the fastest way to reach these targets. The critical point? Silver demand from photovoltaic has no price elasticity. A panel manufacturer cannot choose not to use it because the silver price rose. Silver is fundamental in the product. There's no alternative. Therefore, it must be purchased regardless of cost. This is fundamentally different from jewelry demand. Consumers can forego buying jewelry when silver prices rise. Industrial buyers don't have this luxury. Silver is like a car's fuel, mandatory input. In supply tightness, this creates a price bidding war. Backwardation, indicator of market stress. In late 2025, backwardation structures became prominent in the silver market. This means the futures curve is inverting. Under normal conditions, future delivery prices trade above the spot price. This makes sense. Carrying cost, storage, insurance, you pay a premium to buy in the future. In backwardation, the situation reverses. Spot price is higher than futures price. Immediate delivery is at a premium. This is a red alarm, a signal that market participants have urgent need for physical metal. They're willing to pay extra for immediate delivery rather than wait. In 2025, backwardation gaps reached $2 or more. In commodity markets, this magnitude is abnormal, an indicator of physical scarcity. Major manufacturers in solar and semiconductor sectors are changing behavior. They're moving away from traditional futures markets. Instead, they've started locking long-term contracts directly with miners and refiners. They're paying significant premiums to secure silver supply for the coming years. Why? Because production disruption risk is unacceptable. Consider a photovoltaic factory operator. If silver supply is cut, the entire production line stops. Delivery obligations cannot be met. Contracts break. Operational catastrophe. This panic buying behavior creates additional upward pressure on prices. Historical parallels, 1970s and 2011. This scenario isn't new. We've seen commodity markets go crazy during industrial booms before. In the 1970s, stagflation was experienced, a combination of high inflation and slow growth. During the same period, industrial demand for silver from photography, electronics, and early computing technologies was rising. Silver was also perceived as an inflation hedge. The result? From 1970 to 1980, prices skyrocketed from $1.29 to $50, a 38-fold increase in a decade. The Hunt brothers' attempt to corner the market inflated prices excessively, yes, but the real supply-demand imbalance was the fundamental driver. Another cycle was experienced between 2008 and 2011. Post-financial crisis, silver climbed from $10 to nearly $50. Physical products like the American Silver Eagle sold at premiums of 20 to 50% above spot price. But the critical difference is this. In those periods, demand spikes were driven by financial speculation and macroeconomic chaos. Temporary factors. Today, industrial demand is leading the charge, and industrial demand is sticky, structural. It doesn't disappear when the economy stabilizes. It will grow as the world electrifies and decarbonizes. One more historical parallel. During the electrification boom at the beginning of the 20th century, copper prices skyrocketed. Copper was fundamental for electrical wiring in that period, just as silver is for photovoltaics today. As factories, railroads, cities laid cable, copper demand exploded. Prices rose 50% above trend levels. Bringing new supply online took years. This is exactly what's happening with silver right now. We're in the middle of the green electrification boom. Silver is the copper of the 21st century. 2030 projections. If current trends continue, annual solar installations will reach 1,000 gigawatt levels by 2030. Even in an aggressive thrifting scenario, let's assume silver use per panel decreases by 30% over the next 5 years. The photovoltaic sector will still need 270 to 320 million ounces of silver annually. Add 400 to 500 million ounces from other industrial sectors. Include investment and jewelry demand. Total demand is well over 1 billion ounces annually. The supply side? If miners are lucky, they can add 50 million ounces per year through new projects. If recycling increases, there could be a maximum of 1 billion ounces total supply. The margin is extremely thin. Any disruption, mine closure, geopolitical event, or sudden increase in investment demand shocks the market. This is where the mathematical basis for the $100 target price comes from. Silver is currently at $66 levels. Reaching $100 requires approximately a 50% increase. Is this realistic? Let's look at the fundamental analysis. In 2011, silver briefly touched $50. Industrial demand in that period was a fraction of today's. The photovoltaic sector was consuming 50 to 60 million ounces per year. Today, it's over 200. If structural deficits continue and inventories continue to deplete, buyer behavior changes. Industrial buyers bid prices up for supply security. When investors see the squeeze, they take positions. When this dynamic starts, prices can exceed fundamental valuation. History has proven this. In 1980, silver reached $50 in a frenzy. In 2011, it did it again. In both cases, fundamentals were weaker than today's. Therefore, $100 isn't just possible. It's gaining probability if the current trajectory holds. This isn't just a price story. But this narrative is broader than silver prices. It's about the fragility of the green transition. We're betting our planetary future on technologies dependent on a handful of critical materials. The silver supply chain is a microcosm of the larger problem. There's much talk about photovoltaic farms, wind turbines, and electric vehicle charging networks, but not enough talk about raw material sources. Silver, lithium, cobalt, nickel, rare earths. These aren't infinite. Extraction, refining, and recycling infrastructure requires decades. The goal of electrifying the world in a decade is colliding with hard physical constraints. Scenario analysis. Best case scenario, technological solution. Researchers develop photovoltaic cells that use much less silver or none at all. Perovskite solar cells are a promising alternative, but still in development stage and have durability issues. If this technology scales rapidly, pressure on silver demand could ease. Simultaneously, recycling could increase. First-generation photovoltaic panels will reach end of life in the coming years. Significant amounts of silver can be recovered. But recycling infrastructure is limited. Extracting silver from used panels is an energy and resource-intensive process. The middle scenario seems more likely. Mixed transition, silver prices rise, perhaps reaching $80 to $90. These levels incentivize additional investment in mining and recycling. Manufacturers adapt by using less silver per panel, but don't eliminate it. Photovoltaic deployment continues, but is more expensive than projected. This partially slows the energy transition pace. Governments intervene with subsidy or strategic reserve mechanisms to smooth supply shocks. No crisis, but not a smooth process either. Worst case scenario, deficits deepen, inventories dry up, the silver market comes to a standstill, prices spike to $100 or beyond with panic buying, photovoltaic panel costs rise, slowing installations and threatening climate goals. Geopolitical tensions flare over silver supplies. Countries with major silver reserves like Mexico, Peru, and China can wield outsized influence. Investment demand floods in, further exacerbating the squeeze. In chaos, the green transition stumbles. The critical 5 years. The next 5 years will be decisive. If photovoltaic installations continue to grow at the pace needed for climate goals, silver demand continues to rise. Unless supply catches up through new mining, recycling, or technological breakthroughs, prices move in one direction, up. $100 per ounce is no longer a speculative prediction. It's the logical consequence of observed trends. When silver hits this mark, it won't just be a headline, it'll be a wake-up call. It will force confrontation with the reality that going green isn't just about willpower and policy. It's about physical, finite resources that must be managed wisely. The silver crisis is already here. The silver crisis isn't coming, it's already here. The question is, are we ready to confront it? Every photovoltaic panel carries a material in crisis within it. Silver isn't just a commodity, it's the cornerstone of the green revolution. Right now, we're depleting it faster than we can produce it. The structural deficit is growing, inventories are melting, price discovery is entering a new phase. Industrial buyers are panicking, long-term contracts are being locked. Backwardation is widening. All of these are signals of physical scarcity. 2030 targets are aggressive. 1,000 gigawatts annual installation, 8 terawatts cumulative capacity. The amount of silver needed to reach this target is incompatible with current supply structure. Technology can offer miracles. Perovskite cells can scale. Recycling can ramp up. New mines can come online. But these are processes that take years. Meanwhile, demand is here today. The deficit is growing today. Price pressure is increasing today. Financial markets haven't priced in the seriousness of this yet. $100 silver doesn't enter most portfolio models. Most risk analyses exclude this scenario. But the mathematics is speaking. Physics is speaking. Geology is speaking. 1 billion ounces of demand versus 950 million ounces of supply isn't sustainable. 800 million ounces of cumulative inventory drawdown isn't sustainable. Something has to give. Either price rises dramatically and destroys demand, or supply miraculously expands, or the green transition slows. 3 options. None painless. The silver market is telling us something. Few are listening, fewer are paying attention, but the message is clear. The physical foundations of the renewable energy transition aren't as solid as planned. The scarcity is real. The crisis is structural. The solution is uncertain. At Falling Value, we're closely monitoring this crisis. We continue to analyze silver market dynamics, photovoltaic sector developments, and supply-demand balances. We bring you structural changes that financial markets ignore but will affect your portfolio. Don't forget to subscribe and turn on notifications.